What's up, you guys? Welcome back to Young Money Investments. In today's video, we're going to be talking about the top 5 reasons for supernovas, stocks that run well over 1,000%. What are the things that contribute to making that happen, and how can that benefit you? All today on Young Money Investments. All right, you guys, so one of the things that has happened as of the middle of October is supernovas. We have seen supernovas go crazy as of late, and a lot of people are going, Cameron, how are these stocks running 1,000%, 800%, 1,500% over the course of a few days? And there are 5 main things that I personally believe attribute to supernovas happening. We normally see them starting in the fall. They usually start to dry up kind of in the springtime. And I want to tell you the 5 reasons why these things actually happen. Hey. And don't forget to smash that thumbs up button if you don't mind. First rule is simple: supply and demand. Usually these stocks that are running 1,000%, several 100% in a day are a very low flow, or what we call a micro flow. So as you learned in school in economics class, supply and demand, as supply goes up, demand tends to go down. As supply goes down, demand tends to go up. A lot of these tickers are usually right around 1 million shares in float. What that means is a lot of companies that are larger, like Apple with over 1 billion shares in float, move and fluctuate very small. When these companies move with only 1 million shares able to be bought and sold, there is a very small supply. And because of that, these stocks can go crazy either way. Rule number 2, these stocks tend to go crazy is because of a catalyst, a news catalyst. For example, right now in the middle of October, what we are seeing a catalyst for these companies to move a lot is buyouts or takeovers, companies that are getting bought out by other companies, and they're releasing these press releases that then tend to spike the value of these low float companies. Other times and at different times in the industry, we'll see other sectors like biotechs and biotech breakouts. Companies will start to run because there is a press release that is released by a medical company that they have this great new cancer drug, or they've cured Alzheimer's or Parkinson's. When these phase 2, phase 3 trials are released with positive results, those also tend to pump the stock up, and then we start to see shorts that get in and short squeezes, and we'll talk all about that in another point. One more thing is shippers. Shippers, for some reason, tend to start to pop late in October, November. So each of these sectors within the penny stock market tend to have their own time and when they start to see a little bit more volume. It can also be dependent upon when their earnings reports and things like that tend to come out. Oh, and I cannot forget the weed hype last year. Nobody in the stock market can forget when Cron ran well over $250. I think it was like $273 a share. That was a crazy one. But those things happen on low float runners and when there's a lot of euphoria around any particular industry, like weed was last year. And one more rule: don't forget to smash that thumbs up button, please. It does help me out quite a bit. I went and asked if it didn't really help out the channel, because the channel needs some love right now. Rule number 3, sympathy plays. When one stock tends to go up and go supernova, traders then start to look for a sympathy play the following day. What is the next ticker? What is the next one the mob is going to jump in and shoot up? So there is sympathy plays that start to happen consistently after one supernova happens. One rule that I always like to say is that stock has to have held up previously, though. So if that stock just pops up one day, and it's called a pump and dump, if it pumps up and just dumps right away, that creates a lot of insecurities in traders. They don't want to get into some of those new ones. But if you see a multi-day runner, that tends to build confidence in those traders that want to go long on these penny stocks. And that also helps the sentiment for these sympathy plays. The other thing too is the traders that made money on that particular supernova that ran 2, 3, 4, 5, 800, 1,000%, they are looking to continue to make profits. There are those traders, and then there are those traders that have FOMO, those that sat out and watched the others in their chat rooms and in their groups that ended up making a ton of money, and they sat there and they didn't make anything. So now the following day, they want to get into those stocks, and that cycle continues and continues. And that's what really helps cause these supernovas to continue to run. Reason 4, short squeezes tend to happen. So on any ticker, there's going to be those that are long and bullish on a stock, and there are those that are short or are basically bearish on a stock. What happens is as those shorts start to get into a particular stock, they are selling, and that causes some selling pressure. But if that stock does not dump and more of the buyers tend to buy it and eat it up, basically eat out the ask, no pun intended, that stock will continue to rise up. And when that stock starts to go up, then it causes those short sellers that got in to be squeezed. They're down, they're negative. They have to buy those shares back. It causes the share price to continue to go up. Those that were wanting to get in as well that didn't get in previously start to see that momentum push up. And then the longs get in and it creates this massive push up. So number 4, short squeezes is really a very, very critical and integral part of any supernova, because you need to have those that are getting squeezed on the short side to help push it up, as well as those long traders that are getting in to continue kind of amplify that wave of euphoria in a supernova. Now, rule number 5, I really wanted to think about this one because I kind of got 4 rules down. I was like, what's a good 5th one? And so this one I thought made a whole lot of sense. So I wrote down here, I said manipulation / lack of locates for the short sellers. So basically what that means is there are only so many shares, like I said, in a low float stock. For example, if there are 1 million shares out there, there might be maybe 300 or 400,000 shares that you can actually short of that particular ticker. So what happens is if a lot of those short sellers get in too early, they take all the locates for the shorts. What happens is as that stock continues to push up, there's no more locates for those bears to actually start shorting the stock and force the price down. But those people that got short previously are also going to start wanting to cover because they're getting squeezed. And so that creates this almost lack of locates and that manipulation that then these bigger players with larger accounts can really force the stock up. So like I wrote on here, I said, traditionally a trader, even one with $1 million or greater account, has very little control over the share price and being able to soak up the shorts who are entering on support and trying to crash a stock. What's different is in the penny stock world, when there's only 1 million shares in float, a hedge fund manager or a whale, someone with a lot of money, can actually influence the stock price of these low float stocks very simply and very easily. If something is coming down to support and it looks like it's going to crack, they can actually buy up those sells, those shares that are getting sold, and actually change and reverse the direction because they have a lot more influence now because of the float or number of shares that are able to be traded on that particular company. So like I wrote on here, on a supernova, with the help of the mob, a hedge fund manager or trader with a relatively large account can eat out the ask, said that again, and hold the share price up. So because there are more shares available to long than short, and because borrowing shares is more expensive as locates tend to dry up, long bias traders can tend to control the direction of the stock much more easily than short sellers can. As the price rises, shorts tend to realize they're in trouble. They cover, the price goes higher, or they get trapped and there's no more locates and they tend to get squeezed to high heaven, losing vast amounts of their account. And then they start to cover at the very top. And that's where you start to see these stock prices start jumping $1, $2, $3 in a matter of minutes. So those are my 5 things that I have seen in terms of what is causing supernovas. I hope you found that helpful. I hope you found that intriguing. If you have, please give me a thumbs up. I would greatly appreciate that, and subscribe, turn on the bell notification, and I would love to see you in more of these videos. Check out some more of my content. I would love for you to check that out, as well as We Trade HQ. That is a free trading community. There's a lot of great members in that, long, short bias, everything in between, options trading, you name it, there's everybody inside of We Trade HQ, and that is a free community. Like I said, check out that link below, and I cannot wait to catch you guys in the next video. Talk to you later. Bye.